Good evening, welcome to We Mean Business, and our top focus today is on the long-awaited new bank license guidelines. The Reserve Bank of India today issued the final guidelines for new bank licenses, which say entities notwithstanding which sector they're from and both from the private and the public sector shall now be allowed to apply for a license. Lots of interesting takeaways and surprise elements to discuss from this announcement. So joining us to make sense of what this really means for the sector, well, we have two live guests. Sanjani Kumar, Director at PricewaterhouseCoopers, joins us here in our Mumbai studios. Naresh Maghjani, Partner at KPMG, will join in a bit. I also spoke earlier to three license hopefuls: Bharat Doshi, Executive Director and Group CFO of M&M; Sunil Godwani, CMD of Religare Enterprises; and Ajay Srinivasan, the CEO of Financial Services, the Aditya Birla Group. But before we actually listen into all these people and begin the discussion, our financial policy editor Ira Dugal with the fine print of the new guidelines.
After a wait of nearly 3 years, the Reserve Bank of India has finally put out the guidelines for new banking licenses. It was almost 3 years to the date that Pranab Mukherjee talked about the need for new banks in the budget of 2010-11. Since then, the process has gone through various ups and downs, and finally the guidelines. This is what the guidelines actually say. They put down the eligibility criteria as private entities which are owned and controlled by residents, public sector entities and existing NBFCs, which basically leaves the field wide open. Corporate entities can now apply for a banking license. Even corporate entities linked to sensitive businesses like real estate or brokerage can technically go ahead and apply for a banking license. But the RBI is going to apply a very tough criteria known as the fit and proper criteria in deciding who gets a license. They define that by saying that these entities must have a past track record of sound credentials and integrity. They must have a successful track record of 10 years, and they will seek feedback from other regulators, the enforcement department, the CBI, the IT department, to judge whether these are fit and proper entities. In the previous draft, they had actually taken out entities linked largely to real estate and capital markets. This time, there's no such classification, but there's a very clear quote where the RBI says that promoter and promoter group businesses should not potentially put the bank and the banking system at risk on account of group activities such as those which are speculative in nature and subject to high volatility, which that tells you, if you read between the lines, maybe the RBI would still be uncomfortable with real estate or broking linked businesses, but that is up to the RBI's judgment. The corporate structure for new banks, it would have to be through a non-operative financial holding company. This would hold the bank and other financial service entities. It would also be ring-fenced from other group activities, and that's going to be an important criteria. The RBI says they have to be satisfied about that ring-fencing and also about their ability to actually supervise the bank. Exposure norms are important. They say that the holding company must not have exposure to any group entity, or actually for that matter must keep an arm's length approach with the promoter group, key customers of the promoter group and key suppliers of the promoter group. Capital and shareholding along expected lines. Minimum capital is at 500 crore. The holding within the holding company has to be 40% at least for a period of 5 years. If you're above 40%, you have to bring it down to 40% in 3 years. Shareholding has to be brought down to 20% over 10 years and 15% over 12 years. Listing is mandatory within 3 years. Foreign shareholding has been restricted to 49% in these banks, at least for the first 5 years. Rural exposure is something that's important because the idea behind these licenses was financial inclusion. So these banks will have to have 25% of branches opened in unbanked rural areas. Finally, how is this process going to play out? Take your application, go to the Reserve Bank of India, they'll screen those applications, they'll pass it on to a high-level committee which will look at it, give its recommendations to the RBI, and then the RBI will take a final call on who does or does not get a license. It would probably be a process that would last anywhere between 6 to 12 months.
Here, thanks for getting us that comprehensive fine print of those guidelines. But with that, let's listen in to some of the hopefuls that we've been speaking to. I spoke earlier with Bharat Doshi, the Executive Director and Group CFO of Mahindra & Mahindra. I began by asking him for his initial reactions to the norms.
No, I think it's a fair requirement. If somebody wants to be in the banking business, then an adequate capital ought to be provided at the outset and not that something which will be raised later. And I think it's a fair proposal.
So, but there was a general sense that, it could be a little bit more than 500 crore rupees. Do you think it was lower than what you expected?
What I'm delighted is that the emphasis by RBI, particularly on good governance, on sound track record and on integrity on one side, and simultaneously has talked about rural presence, has talked about inclusive area, and that delights me most because Mahindra Finance is a company which qualifies on both these criteria.
So which leads me to my next logical question: are you going to apply?
So that's like all the necessary safeguards required, and that's why they in themselves brought that you will not lend within the companies in the group, or the safeguards which will come in terms of how your asset allocation will take place, how the priority.
Alright, there's some technical error over there. We'll try and fix that. But I also spoke earlier with Ajay Srinivasan, the CEO of Financial Services at the Aditya Birla Group. I, of course, began by asking him for his initial reactions on the norms. Listen in.
So we welcome the norms. I think the norms allow for quite a change in financial services overall in India and will promote the cause of financial inclusion.
Sir, you know, the norms also state that businesses should not put the bank and the banking system at risk. That's what the norms state. How do you read into this? Is there a general sense the Reserve Bank of India would be very, very strict in picking who they give the licenses to?
I think that's a statement of intent. I guess there are a number of things in the guideline that obviously allow this in terms of the kind of experience that the promoter has to have, the kind of structure that will be created, the kind of supervisory powers that the RBI will have. I think there are a number of elements in the guidelines that will support this intent.
And of course, I also spoke to Sunil Godwani, the CMD of Religare Enterprises. I began by asking him whether Religare is going to apply given that the final guidelines are out.
We have always expressed our interest that for Religare Enterprises as a fully integrated one-stop financial services house, it's natural to evolve as a bank. We have the guidelines. We'll go through all the other details and the fit and proper definitions that RBI may have, and definitely we are very keen to apply for it.
But sir, the norms state that current businesses should not put bank and banking system at risk. The same question that I asked Mr. Srinivasan, how do you read into this? Is this going to mean that the RBI is going to be very selective in picking who it gives licenses to?
Basically, what they are saying is that they don't want any systematic risk. So the non-operative holding company will cover all the financial services, and there will be no lending allowed to any group company. So a bank cannot be used to lend to your own company. Which is from a governance standard, they have also said that there will be independent board, which is absolutely fine. So what they are basically saying is they are ensuring that a new bank that is being set up today in an environment which is challenging anyway, there is absolutely very little chance, or no chance for any systematic failure from any side to a bank, which I feel is very positive again. I mean, whatever is being put forward is the right thing to do for the industry. You don't want a bank failing, which will be a very negative aspect to the whole sector there.
And sir, your reaction on the initial sort of capitalization, 500 crore rupees, is that a little lower than you had expected?
So capitalization is a function of plans. I mean, they are very clear. It has to be a financial inclusion. So I would say to put up a meaningful bank and also achieve the financial inclusion as specified by them, it's an appropriate amount. However, it depends on specific business plans that are put together. But a 500 crore capitalization as a minimum level, I think is pretty fair in expectancy,
Sir, in terms of exposure norms, they state that the bank cannot invest in debt, equity, promoter holding, and also have to maintain an arm's length distance as far as suppliers are concerned. How do you react to that?
No, which is what I just said. So if you are a bank, you cannot invest in yourself or any of the companies related to the promoter, which is normal. I mean, that is what would be expected. So this doesn't come as a surprise at all. Anyway, even today, there are norms in place, concentration norms in place if you are investing in related parties. So as a bank, you would be expected that you would not fund yourself from any aspect, which is a pretty accepted norm, I would say.
And finally, sir, of course, the whole issue of 25% branches in rural areas, do you think that's going to be a hurdle for some of the players at least?
Well, there's always a challenge. It will be a challenge, but that is what the norm is, and one will have to comply with it. From a relegate perspective, we have always expanded more in tier 2, tier 3 cities, and we feel, that a lot of technology use will be required to really penetrate for true financial inclusion. Again, that is what they want. One will have to build a business plan around it.
All right, with that, let's in fact discuss this with an independent set of experts, and I have Shinjini Kumar, Director at PricewaterhouseCoopers, joining me here in the Mumbai studios. Shinjini, thanks for coming in. Your initial reaction on the guidelines, 2-3 surprises. One is, of course, that PSU banks were allowed, and also everyone has now been included. There were talks about brokerages, real estate firms not being included in this, but that's not happened.
Yes, so are you happy or are you not happy?
You're the expert.
Okay, so I think what it does, the fact that you leave the field wide open is sort of give it a political correctness. So you're not creating entry barriers. At the same time, the bank licenses are commodities that cannot simply be given out, and therefore there will probably be more applicants than there are licenses. Just like in this country, right from your kindergarten to your crematorium, there are more people in the queue than the services available. So therefore there will be a larger pool of applicant, and there has to be a positive discrimination to choose the best and the fittest possible bank, and that remains. So the guidelines create the framework for people who take those decisions to take good decisions.
Right, but that fit and proper criteria which you spoke about is a little bit vague. It's a bit spread out, because what it says is that promoter and promoter group businesses should not potentially put the bank and the banking system at risk on account of group activities such as those which are speculative in nature or subject to high asset price volatility. But while this is a large context that these licenses have put in, there are no there are many people who would fit into these norms. Who do you give the license to?
Yes, so this is what. So this is not the this is a necessary condition, and it need not be a sufficient condition. So then you are choosing among people who may appear to be equal. See, one of the fundamental challenges is that the bank licenses have come at a time when it appears to be something that will happen for a short period of time, and then there is a lot of uncertainty about when it may happen again, and therefore the scramble to apply for the license is a lot more than it probably should be if it was to be based on the genuine business case of each applicant per se. So therefore I think sorry to interrupt you, but is that scramble going to get even more mad, because the initial capital is 500 crore rupees? There were suggestions coming in for 1,000-2,000 crore rupees. The 500 is a little bit lower than what we'd expected. So there are two issues here. One is that merely eliminating people on the basis of capital then creates an incentive to come with a higher and higher amount of capital. So it becomes almost like a bid, but then you don't necessarily know how that capital has been tied up, at what cost and with what conditionalities. So that's one challenge. And the second challenge is that you already have existing banks in the system. Many of them are old private sector banks, and you have capital guidelines for them. Now you suddenly create a huge jump. It affects the whole system. So I'm not so sure that that was the right way to do it. But in my view, not having a time limit on it would perhaps be a better way to calibrate entry of banks into the market based on the more on the commercial dynamics of each bank entrant and how the market is behaving or the market is expected to behave. So I guess I'm trying to say is that people would take more commercially sound decisions based on banking rather than decisions as an investor. So today it almost seems like it's a commodity in which I'm investing because there's a bigger value to it than the value itself. And of course, so your difficulty is to discriminate between applicants who think like that and applicants who genuinely necessarily are capable of and are interested in building long-term sound financial institutions, which is what you want.
Right. So you're saying that the capital and shareholding norms would ensure that only the serious players would come in. But what about the PSU entities? That was completely unexpected.
Yeah, at least for me that was unexpected, because the emphasis had all along been on private sector, and there was a little bit of confusion about it. So what has happened now is that again the field becomes wider open, so you have more applicants. But we should remember one thing. I guess there are entities today in the market that have a public sector tag or some bit of public sector ownership, but may not necessarily be the same kind of institutions as what we mean when we talk about a Punjab National Bank or a State Bank of India. So, you know, the standard public sector banks. So this is more about ownership being institutional, and part of which may be owned by government-owned institutions, so not necessarily public sector in that sense. So we still have to see what kind of applicants come in, and how much wider that makes it for the field. But it does make it interesting, considering that the government has not shown much appetite to inject capital into its public sector banks in a very big way, for which there is ample room given all the Basel II, Basel III implementation, etc.
And that's the one challenge that would come in as well, right? Because if you have another public sector bank coming in, your capital infusion needs every year would go up.
Yeah, so therefore my sense is that we are not talking so much about the standard public sector bank model. We are talking more about institutional ownership, which may technically be public sector. And I'm just taking a guess there.
So do you see somebody like an LIC, for instance? I mean, a lot of people, you know, suggesting that this could have been done keeping LIC in mind. Do you see that happening?
I would like to speculate on a name, but once we have the applicants, then we will perhaps get to understand what was driving this.
Okay, the one challenge that everybody is talking about is the sort of you know, compulsion to have 25% of branches in the unbanked rural areas. Is that going to in some sense deter many people from participating? Is that a hurdle?
See, what I'm seeing is that there are a lot of potential applicants who have already cracked the distribution code of small value, high volume distribution, which seems like a business model that works in a country like India. So whether you look at FMCG sector, whether you look at any telecom, you look at any sector, that the success stories have all come from the ability to distribute small ticket items. Now in banking that has not happened, because banking has been on the demand side constrained, and therefore on the supply side it has been constrained, and on the demand side we've had a growing economy, and therefore banks have been given a lot of push by regulators to get into that space, but there is enough money to be made in the other space. Now we are talking about a situation where banks will actually genuinely go and make financial sense out of that. So it will have to be a sort of a disruptive business model which can make sense out of that. So many of these people have already gone into that space, probably not so much in rural centers, but in many small centers.
Is it unfair because there's no level playing field?
So that is an issue that would worry us, not so much if these decisions were being driven purely out of commercial reasons. Right. So if I as an entity decided to get into that space because I thought that's a commercial opportunity that I must tap, and other people have neglected it, it was a good idea. But if I had to also bear the same cost on my capital, I had I had to hire the same kind of people, I had to compete in the same market, and I wasn't really able to do it because of those factors, then it would be unfortunate. So I guess it's from a regulator's perspective, level playing field should be an important criteria. Okay,
let's talk about the sort of larger philosophical issue of actually allowing corporates into the banking sector. What's the global precedent for this? There are not too many global precedents, for instance, in the US. And has there been enough ring fencing done by the Reserve Bank of India to ensure that risk isn't heightened in the sector as a whole?
See, I go back to the latest global financial crisis. Risk is a very interesting thing, because all of us think about, all of us know that risk is a dynamic and proactive entity, but all of us think about risk and get weighed down by what has happened in the past. So if you see the latest financial crisis, the source of that risk wasn't coming from corporate ownership of the banking system, and therefore today we may ring fence against that particular issue, and the risk tomorrow may come at us from something else. So I guess what I'm trying to say is that there is no insurance against risk. So you cannot predeterminedly come up with a model which sufficiently insures you against any form of risk. So there has to be a continuous process of good regulation, good supervision, good understanding, good governance, which is the most important thing.
Right, and you spoke about supervision, so I want to talk a little bit more about the exposure norms and so on. It very clearly says that banks cannot have exposure to promoter group entities or individuals associated, which is fine. But it also says banks should maintain arm's length with promoter groups, its major suppliers and major customers. You know, that would mean micromanaging by the Reserve Bank of India. And what would it mean for big conglomerates like an Aditya Birla Group, for instance, or a Tata Group, who have a presence all over the country, a diversified presence all over the country?
Yeah, I mean, if I touch every Indian's life in some way, where do I draw the potential conflict of interest issue? But I don't think it's that difficult. I would expect that going forward, the supervisory mechanism will come up with more detailed and specific guidelines on what is it that they seek to bar or seek to look for. What will be important is a little proactive engagement in making those rules clear, and I think the guidelines in that sense make it explicit enough that for groups that consider it to be a significant disadvantage to them, they should probably factor that into their calculation before they apply for the banking license. So it's not something which you've not been warned. In fact, you have been told that there can be very strict restrictions, and knowing the fact that Reserve Bank of India means what it says, going forward it may become very difficult to carry on business in that manner. So I don't think anybody will enter into it with the idea to get around these regulations, so they will factor it into their understanding.
So lots of sort of precautions taken by the Reserve Bank of India is the general sense that we're getting. Also, our finance ministry sources telling us that the RBI is likely to issue around 4 or 5 new banking licenses. So like Shanjini was saying, there's going to be a scramble of activity, but only a few people will actually end up getting, and that of course would be left to the subjective discretion of the Reserve Bank of India. Clearly, this is a very, very important issue that was playing out in the banking sector, and that's finally come through. We will have to see how really it ends up playing out. Shanjini, thanks so much for joining us, and thanks for joining us on We Mean Business. On the other side, we'll of course get you a discussion on why the skies in India buzzing. The aviation space clearly looks like it's going to be turning around. Stay tuned.